virtually identical to the investment return of 9.5%, 4.5% from dividend yield, and 5% from earnings growth. That tiny difference of 0.1% per year arose from what I call speculative return, depending on how one looks at it, perhaps merely statistical noise, or perhaps from a generally upward long-term trend in stock valuations, reflecting the willingness of investors to pay higher prices for each dollar of earnings at the end of the period than at the beginning. Compounding these returns over 106 years produced accumulations that are truly staggering. Each dollar initially invested in 1900 at an investment return of 9.5% grows by the close of 2005 to $14,808. Sure, few, if any of us have 106 years in us, but, like the Gottrocks family over the generations, the miracle of compounding returns is little short of amazing, perhaps the ultimate winner's game. Footnote. But let's be fair. If we compounded that initial $1, not at the nominal return of 9.5%, but at the real, after-inflation rate of 6.5%, the accumulation grows to $793. But increasing real wealth nearly 8 times over is not to be sneezed at. Yes, there are bumps along the way in the investment returns earned by our business corporations. Sometimes, as in the Great Depression of the early 1930s, these bumps are large. But we get over them. So, if you stand back and squint your eyes, the trend of business fundamentals looks almost like a straight line sloping gently upward, and those periodic bumps are barely visible. Note, however, that stock market returns sometimes get well ahead of business fundamentals. The late 1920s, the early 1970s, the late 1990s. But it has been only a matter of time until, as if drawn by a magnet, they soon return, although often only after falling well behind for a time. The mid-1940s, the late 1970s, the 2003 market lows. In our foolish focus on the short-term stock market distractions of the moment, we too often overlook this long history. We ignore the fact that when the returns on stocks depart materially from the long-term norm, it is rarely because of the economics of investing, the earnings growth and dividend yields of America's corporations. Rather, the reason that annual stock returns are so volatile is largely because of the emotions of investing. We can measure these emotions by the price-earnings ratio, which measures the number of dollars investors are willing to pay for each dollar of earnings. As investor confidence waxes and wanes, P/E multiples rise and fall. Changes in interest rates also have an impact, uneven though it may be, on the P/E multiple, so I'm oversimplifying a bit here. When greed holds sway, we see very high P/Es. When hope prevails, moderate P/Es. When fear is in the saddle, P/Es are very low. Back and forth, over and over again, swings in the emotions of investors momentarily derail the long-range upward trend in the economics of investing. While the prices we pay for stocks often lose touch with the reality of corporate values, in the long run, it is reality that rules. So while investors seem to intuitively accept the idea that the past is inevitably prologue to the future, any past stock market returns that have included a high speculative stock return component are deeply flawed as a guide to what now lies ahead. To understand why past returns do not foretell the future, we need only heed the words of the great British economist John Maynard Keynes, written 70 years ago. It is dangerous to apply to the future inductive arguments based on past experience, unless one can distinguish the broad reasons why past experience was what it was. But if we can distinguish the reasons why the past was what it was, then we can establish reasonable expectations about the future. Keynes helped us make this distinction by pointing out that the state of long-term expectation for stocks is a combination of enterprise, forecasting the prospective yield of assets over their whole life, and speculation, forecasting the psychology of the market. Chapter 12 of the General Theory of Employment, Interest, and Money, John Maynard Keynes, 1936. I'm well familiar with those words, for 55 years ago I incorporated them in my senior thesis at Princeton, written providentially for my lifetime career that followed, on the economic role of the investment company, the title I chose for the thesis. This dual nature of returns is clearly reflected when we look at stock market returns over the decades. Using Keynes' idea, I divide stock market returns into 1. Investment return, enterprise, consisting of the initial dividend yield on stocks plus their subsequent earnings growth, together the essence of what we call intrinsic value, and 2. Speculative return, the impact of changing price-earnings multiples on stock prices. Let's start with the average annual returns on stocks over the decades since 1900. The steady contribution of dividend yields to total return during each decade is always positive, only once outside the range of 3% to 7%, and averaging 4.5%. The contribution of earnings growth to investment return, with the exception of the depression-ridden 1930s, was positive in every decade, usually running between 4% and 7%, and averaging 5% per year. Result: total investment returns, which combine dividend yield and earnings growth, were negative in only a single decade, again the 1930s. These total investment returns, the gains made by business, were remarkably steady, generally running in the range of 8% to 13% per year, and averaging 9.5%. Enter speculative return. Compared with the relative consistency of dividends and earnings growth over the decades, truly wild variations in speculative return occur as price-earnings ratios, PEs, wax and wane. A 100% rise in the PE from 10 to 20 times over a decade, for example, would equate to a 7.2% annual speculative return. Curiously, without exception, every decade of significantly negative speculative return was immediately followed by a decade in which it turned positive by a correlative amount. The quiet 1910s, and then the roaring 1920s, the dispiriting 1940s, and then the booming 1950s, the discouraging 1970s, and then the soaring 1980s. Reversion to the mean, RTM, writ large. Then, amazingly, we see an unprecedented second consecutive exuberant increase in speculative return in the 1990s, a pattern never before in evidence. By the close of 1999, the PE rate had risen to an unprecedented level of 32 times, setting the stage for the return to sanity in valuations that soon followed. The tumble in stock market prices gave us our comeuppance. With earnings continuing to rise, the PE currently stands at 18 times, compared to the 15 times level prevailing at the start of the 20th century. As a result, speculative return is added just 0.1 percentage points to the annual investment return earned by our businesses over the long term. When we combine these two sources of stock returns, we get the total return produced by the stock market itself. Despite the huge impact of speculative return, up and down, during most of the individual decades, there is virtually no impact over the long term. The average annual total return on stocks of 9.6% then has been created almost entirely by enterprise, with only 0.1 percentage point created by speculation. The message is clear. In the long run, stock returns depend almost entirely on the reality of the investment returns earned by our corporations. The perception of investors, reflected by the speculative returns, counts for little. It is economics that controls long-term equity returns. Emotions, so dominant in the short term, dissolve. Even after almost 55 years in this business, however, I have absolutely no idea how to forecast these swings in investor emotions. I'm not alone. I don't know anyone else who has done so successfully, or even anyone who knows anyone who has done so. In fact, 70 years of financial research shows that no one has done so. But largely because the arithmetic of investing is so simple, I believe I can forecast the long-term economics of investing with remarkably high odds of success. Why? Simply because it is investment returns, the earnings and dividends generated by American business, that are almost entirely responsible for the returns delivered in our stock market. Put another way, While illusion, the momentary prices we pay for stocks, often loses touch with reality, the intrinsic values of our corporations, in the long run, it is reality that rules. To drive this point home, think of investing as consisting of two different games. Here's how Roger Martin, Dean of the Rotman School of Management of the University of Toronto, describes them. One is the real market, where giant publicly held companies compete, where real companies spend real money to make and sell real products and services, and, if they play with skill, earn real profits. This game also requires real strategy, determination, and expertise, real innovation, and real foresight. Loosely linked to this game is another game, the expectations market. Here, prices are not set by real things like sales margins or profits. In the short term, stock prices go up only when the expectations of investors rise, not necessarily when sales, margins, or profits rise. To this crucial distinction, I would only add that the expectations market is not only a product of the expectations of active investors, but the expectations of active speculators, trying to guess what these investors will expect and how they will act as each new bit of information finds its way into the marketplace. The expectations market is about speculation. The real market is about investing. The only logical conclusion: the stock market is itself a giant distraction that causes investors to focus on transitory and volatile investment expectations rather than what is really important, the gradual accumulation of the returns earned by corporate business. My advice to investors is to ignore the short-term noise of our emotions reflected in our financial markets and focus on the productive long-term economics of our corporate businesses. Shakespeare could have been describing the inexplainable hourly and daily, sometimes even yearly or longer, fluctuations in the stock market when he wrote, "Like a tale told by an idiot, full of sound and fury, signifying nothing." The way to investment success is to get out of the expectations market of stock prices and cast your lot with the real market of business. Don't take my word for it. Simply heed the timeless distinction made by Benjamin Graham, legendary investor, author of The Intelligent Investor, and mentor to Warren Buffett. He was right on the money when he put his finger on the essential reality of investing. In the short run, the stock market is a voting machine, but in the long run, it is a weighing machine. Ben Graham continues, using his wonderful metaphor of Mr. Market. The investor with a portfolio of sound stocks should expect their prices to fluctuate and should neither be concerned by sizable declines nor become excited by sizable advances. He should always remember that market quotations are there for his convenience, either to be taken advantage of or to be ignored. Imagine that in some private business you own a small share which cost you $1,000. One of your partners, named Mr. Market, is very obliging indeed. Every day he tells you what he thinks your interest is worth, and furthermore, offers either to buy you out or to sell you an additional interest on that basis. Sometimes his idea of value appears plausible and justified by business developments and prospects. Often, on the other hand, Mr. Market lets his enthusiasm or his fears run away with him, and the value he proposes seems little short of silly. If you are a prudent investor, will you let Mr. Market's daily communication determine your view as the value of your $1,000 interest in the enterprise? Only in case you agree with him, or in case you want to trade with him. Most of the time, you will be wiser to form your own ideas of the value of your holdings. The true investor will do better if he forgets about the stock market and pays attention to his dividend returns and to the operating results of his companies. Chapter 3. Casting Your Lot with Business. Occam's Razor Writ Large. So how do you cast your lot with business? Simply by buying a portfolio that owns the shares of every business in America and then holding it forever. It's a simple concept that guarantees that you will win the investment game played by most other investors who, as a group, are guaranteed to lose. Please don't equate simplicity with stupidity. Way back in 1320, William of Ockham expressed it well, essentially setting forth the precept that, when there are multiple solutions to a problem, choose the simplest one. William of Ockham actually expressed it more elegantly. Entities should not be multiplied unnecessarily. But the point is unmistakable. And so Occam's razor came to represent a major principle of scientific inquiry. And so too is owning all of U.S. business the essence of simplicity achieved by holding the stock market portfolio. For most of the past 80 years, the accepted stock market portfolio was represented by the Standard & Poor's 500 stock index, created in 1926 and now holding a list of 500 stocks, essentially composed of America's 500 largest corporations, weighted by the value of their market capitalizations. The index originally included just 90 companies, rising to 500 in 1957. In recent years, these 500 stocks have represented about 80% of the market value of all U.S. stocks. The beauty of a cap-weighted index is that it automatically adjusts to changing stock prices and never asks to buy and sell stocks for that reason. With the enormous growth of corporate pension funds during the 1950 to 1990 era, it was an ideal measurement standard, the benchmark or hurdle rate that would be the comparative standard for how their professional managers were performing. Today, the S&P 500 remains a valid standard against which to compare the returns earned by the professional managers of pension funds and mutual funds. In 1970, an even more comprehensive measure of the U.S. stock market was developed. Originally called the Wilshire 5000, it is now named the Dow Jones Wilshire Total Stock Market Index. It includes some 4,971 stocks, including the 500 stocks in the S&P index. However, because its component stocks too are weighted by their market capitalization, those remaining 4,471 stocks account for only about 20% of its value. Nonetheless, this broadest of all U.S. stock indexes is the best measure of the aggregate value of stocks, and therefore a superb measure of the returns earned in U.S. stocks by all investors as a group. Of course, the two indexes have very similar composition. Consider, for example, the 12 largest stocks in each and their weight in the construction of each index. It is hardly surprising that the two indexes have earned returns that are in lockstep with one another. The Center for Research in Security Prices at the University of Chicago has gone back to 1926 and calculated the returns earned by all U.S. stocks. Its data since 1970 have provided a virtually perfect match to the Dow Jones Wilshire Total Stock Market Index. In fact, returns of the two indexes parallel one another with near precision. From 1928 through 2006, you can hardly tell them apart. For the full period, the average annual return on the S&P 500 was 10.3%. The return on the total stock market was 10.1%. Of course, this represents what we call a period-dependent outcome. Everything depends on the starting date and the ending date. If we began the comparison at the beginning of 1930, instead of 1926, for example, the returns of the two were identical, 9.9% per year. Yes, there are variations over the interim periods. The S&P 500 was much the stronger, for example, in 1982 through 1990, when its annual return of 15.6% outpaced the total market index return of 14%. But in recent years, 1998 through 2006, small and mid-cap stocks did better, and the total market index return of 3.4% per year nicely exceeded the 2.4% return of the S&P 500. But with a long-term correlation of 0.98 between the returns of the indexes, 1.0 is perfect correlation, there is little to choose between them. Whichever measure we use, it should now be obvious that the returns earned by the publicly held corporations that compose the U.S. stock market must of necessity equal the aggregate gross returns earned by all investors in that market as a group. Equally obvious, as we'll learn in detail in the next chapter, the net returns earned by these investors must of necessity fall short of those aggregate gross returns by the amount of intermediation costs they incur. Thus, the reality of investing is that investors as a group must lose to the returns earned by business. This reality is obvious. While owning the stock market over the long term is a winner's game, beating the stock market is a loser's game. Such an all-market fund is guaranteed to outpace over time the returns earned by equity investors as a group. Once you recognize this fact, you can see that the index fund is guaranteed to win not only over time, but every year and every month and week, even every minute of the day. Because no matter how long or short the time frame, yes, the gross return in the stock market, minus intermediation costs, equals the net return earned by investors as a group. If the data do not prove that indexing wins, well, the data are wrong. Over the short term, however, it doesn't always look as if the S&P 500 index, still the most common basis of comparison for mutual funds and pension plans, or the Dow Jones-Wilshire 5000 index is winning. That's because there is no possible way to calculate the returns earned by the millions of diverse participants, amateur and professional alike, Americans and investors in foreign countries, in the U.S. stock market. So what we do in the mutual fund field is calculate the returns of the various funds, counting each fund rather than each fund's assets as one entry. Since there are lots of small cap and mid cap funds, usually with relatively modest asset bases, they make a disproportionate impact on the data. When small and mid cap funds are leading the total market, the all-market index fund seems to lag. When small and mid cap stocks are lagging the market, the index fund looks formidable indeed. Nonetheless, the exercise of calculating how the returns earned by the stock market itself compares with returns earned by the average equity fund is both illuminating and persuasive. If we compare the results of what are described as large-cap core funds with the returns of the S&P 500, because of its market capitalization weightings, a large-cap core index, the advantage of the index itself is impressive. During the 37-year period, 1969 to 2006, the S&P 500 index fell into the bottom quartile in only 2 years and has not done so since 1979. The index has outpaced the average fund in 26 of the remaining 35 years, including 11 of the past 15 years. Its average ranking was in the 58th percentile, that is, outperforming 58% of the comparable actively managed funds, leading, as we shall see in the next chapter, to enormous superiority over time. It is hard to imagine that even a single one of the large-cap core equity funds has a similar record of consistency. Consistency matters. A fund that is good or very good in the vast majority of years produces a far larger long-term return than a fund that is superb in half of the years and a disaster in the remaining half. Single-year rankings, then, ignore the sheer arithmetic advantage of that consistency. In the coming chapters, the impact of that long-term consistency is cataloged over the past 25 years. I should add that these annual data are what we call survivor biased. That is, that they exclude the records of the inevitably poorer performing funds that regularly go out of business. As a result, this further understates the success of the market-owning index strategy. Investing in the first index mutual fund, $15,000 invested in 1976, value in 2006, $461,771. Much criticism has been heaped on the S&P 500 for its choice of stocks, often picking new economy stocks such as JDS Uniphase and Yahoo near their inflated peak prices during the bubble just before they crashed, taking on a growth bias at exactly the wrong time. While the criticism is valid, the excellent long-term record of the flawed index belies the existence of a significant problem. In fact, since the market peaked early in 2000, the S&P 500 has had only a single significantly subpar year, 2000, 3 years at about par, and 3 years, 2003, 2004, and 2006, in the top quartile of its peers. I can't imagine that the vast majority of money managers wouldn't have been ecstatic with such an outcome. Thus, the recent era has not only failed to erode, but nicely enhanced the lifetime record of the world's first index fund, now known as Vanguard 500 Index Fund. Let me be specific. At a dinner on September 20th, 2006, celebrating the 30th anniversary of the fund's initial public offering, the counsel for the fund's underwriters reported that he had purchased 1,000 shares at the original offering price of $15 per share, a $15,000 investment. The value of his holding that evening, including shares acquired through reinvesting the fund's dividends and distributions over the years, he proudly announced, was $461,771. Now there's a number that requires no comment. Well, maybe one comment. Of the 360 equity mutual funds then in existence, only 211 remain. This cumulative long-term winning record confirms that owning American business through a broadly diversified index fund is not only logical, but to say the least, incredibly productive. Equally important, it is consistent with the age-old principle expressed by Sir William of Ockham. Instead of joining the crowd of investors who try to gain an edge by dabbling in complex machinations involved in picking stocks and trying to outguess the stock market, two tasks that are inevitably fruitless for investors in the aggregate, choose the simplest of all solutions: buy and hold the market portfolio. Don't take my word for it. Before you write off the value of the simple index fund solution, recognize that it has been adopted as a cornerstone of investment strategy for many of the nation's pension plans operated by our giant corporations and state and local governments. Indexing is also the predominant strategy for the largest of them all, the retirement plan for federal government employees, the Federal Thrift Savings Plan. The plan has been a remarkable success and now holds some $173 billion of assets for the benefit of our public servants and members of uniformed services. Under the plan, the various government departments automatically make a contribution equal to 1% of annual pay, and matching contributions of up to 5% of pay, meaning that a federal employee who contributes 5% of their salary to the plan receives a total matching contribution of 6%. All contributions and earnings are tax-deferred until withdrawal, much like the corporate 401k thrift plans. Overcoming what must have been some serious reservations, even the Bush administration determined to follow the Federal Thrift Savings Plan model in its plan for personal savings accounts as an optional alternative to our Social Security program. Indexing is also praised across the Atlantic pond. Listen to these words from Jonathan Davis, columnist for the London Spectator. Nothing highlights better the continuing gap between rhetoric and substance in British financial services than the failure of providers here to emulate Jack Bogle's index fund success in the United States. Every professional in the city knows that index funds should be core building blocks in any long-term investor's portfolio. Since 1976, the Vanguard Index Fund has produced a compound annual return of 12%, better than 3/4 of its peer group. Yet even 30 years on, ignorance and professional omerta still stand in the way of more investors enjoying the fruits of this unsung hero of the investment world. Chapter 4. Why Most Investors Lose to the Market. The Relentless Rules of Humble Arithmetic. Before we turn to the success of indexing as an investment strategy, let's explore in a bit more depth just why it is that investors as a group fail to earn the returns our corporations generate through their dividends and earnings growth, ultimately reflected in the long run in the prices of their stocks. To understand why they do not, we need only to recognize the simple mathematics of investing. All investors as a group must necessarily earn precisely the market return, but only before the costs of investing are deducted. After subtracting the costs of financial intermediation, all of those management fees, all of those brokerage commissions, all of those sales loads, all of those advertising costs, all of those operating costs, the returns of investors as a group must and will and do fall short of the market return by an amount precisely equal to the aggregate amount of those costs. In a market that returns 10%, we investors together earn a gross return of 10%. Duh. But after we pay our financial intermediaries, we pocket only what remains. And we pay them whether our returns are positive